Thank you so much for coming back and joining us. We know more people are coming into the room, but we're going to start with the introduction. So, as I would have said earlier, guys, this is not a bright people conversation and a smart people conversation. Don't let the topic fool you or the illustrious panelists fool you. Again, we are breaking it all the way down, keeping it all the way real, because we understand, based on the feedback that we would have gotten, especially on social media, that folks are concerned, a little bit confused. They hear a lot of things coming out, BOJ raising interest rates, da, 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 da. What does that mean? How that going to impact my money? What should I be doing differently? And so we said, that had to be one of our conversations for Elevate 4.0 when we were talking about level setting in 2022. So that's what we're here all about. And we have another fantastic panel of people who are here to share their knowledge and expertise. As always, I like to say the caveat is that we're not giving financial advice here, people. Okay, very, very important. This is for educational and informational purposes only. If you wish to get your own personal financial advice, then please, by all means, reach out to a licensed financial advisor. And JMMB has tons of them, of course. So, just putting that out there to take care of some housekeeping. So without further ado, let me introduce our fantastic panel. Now, our panel for this session will be moderated by, let me tell you, she walked in and she done the whole away with how fantastic she looked this evening, okay? She is the fantabulous, the awesome, the great Kalila Reynolds. She is the CEO, yes, of Kalila Ray Media, but Kalila is just all things money these days, and we just put that out there. And Kalila, of course, is no stranger to JMMB, no stranger to JMMB Elevate. In fact, I think this is your third year straight being part of the family, and she's going to be moderating this year, right? So we're very happy to have you. Welcome, Kalila. Now, her two panelists that will be joining her, first and foremost, he is certainly no stranger to a lot of us either. Now, I'm a graduate of the great University of the West Indies, Mona campus, and I said to him he was my favorite lecturer when I was on UWI campus. I see some head nods in the back there, because guess what? This is one of my team members, because I'm not going to tell you what year that was, but he was my econ lecturer, and like I tell you, look out for his classes, because not only was he, of course, very wise and knowledgeable, but he used to just have us just cracking. He really made it fun, and I just loved him. So it's good to see him again, Dr. Damian King. He's no longer lecturing full-time, but he is the executive director of Capri. Thank you very, very much for joining us, Dr. King. And then now we have, last but by no means least, he is a member of the JMMB team. And we actually have him as a guest and use him for a number of different activities when we need to talk about all things pertaining to the economy. And he is Theodore Mitchell. Theodore is one of our gurus at JMMB when we talk about the economy. We have some sexy titles at JMMB, and sometimes people are like, what does that mean? He just knows about the economy. When you want to talk about the economy and what's happening and all that sort of thing, Theo is your man. So I'm going to hand over to Kalila. I'm going to crawl out of the set and hand over to Kalila, who will be taking us through this next session. Thank you.
Thank you so much, Carrie Ann. It's so nice to see you in person and to see, boy, you can see what goes on backstage. It's so nice to see Carrie Ann in person. So nice to see my esteemed panelists in person. Damien, we had a session earlier this week via Zoom. Theo, I see you regularly on my show taking stock, but now we actually get to liaise in person. And then, of course, you, our esteemed audience, are joining us online. And I know that you are very pleased to be here as well. As Carrie Ann said, my name is Kalila Reynolds, and it's my pleasure to be hosting you for this panel. And as she said again, it is my third time participating in JMMB's Elevate, so this is exciting stuff for me. Well, our objective this evening is to talk about inflation and interest rates. And as our host said for this evening as well, we're going to break it down to the basics because my thing is all about making business and finance easy to understand. So you've been hearing these big terms flying around. You're not quite sure what it means, not quite sure how it affects your pocket. We're going to break that all down this evening. So we want to understand the investment landscape for 2022. There's an expectation that interest rates are going to continue creeping up. So what does that mean for your investments, for your savings, for prices of goods and services? How will this affect the entire investment landscape in 2022? That's what we're here to find out. So inflation is the other big word. So we've heard interest rates. We've heard about inflation. That's the other thing that's going to continue having an impact on the investment landscape this particular year, affecting all aspects of the economy, from consumer spending to businesses to borrowing to so many different things, employment, just to name a few. So let's bring in our esteemed panel. Are you ready, gentlemen?
Ready and waiting.
Well, Damien, you told me you would be dolled up this evening and you didn't disappoint.
You know, you have to get cleaned up and look nice when you go in front of people.
Yeah, you're bait.
Yeah. Take a bath.
All right, Theo, I actually want to start with you, and we just want to demystify inflation. What is it and what causes it?
Okay, inflation is just simply increase in goods and services, and there are a number of things which can lead to increase inflation. There is demand pull inflation in a situation where it is that wages and salaries going up, persons having high disposable income buying goods and services. You could see significant rise in terms of prices if it is that there is some amount of supply constraint. On the other hand, you could have a situation where it is that there's an increase in terms of inputs, like what we're seeing now on the global economy. For example, Jamaica imports a lot of goods and services, and we've seen over the last couple of months where there has been significant rise in terms of shipping costs, etc. And yes, that is having a monumental impact in terms of local produce. In fact, I saw earlier this week where it is that Jamaica broilers is actually increasing the price of chicken products. Ouch. Because it is facing significant rise in terms of pricing of its inputs.
Mm-hmm. And chicken being one of the major proteins consumed here, that's going to have an impact on your KFC. Very popular KFC, as well as many, many other dishes, and of course your own household spending, right?
Indeed.
All right, so just a quick recap. You mentioned input costs rising, the shipping stuff, and then you also mentioned demand pull inflation. So break that down for me again.
Okay, all right. Let's bring it, for example, to what is happening in the United States. In 2020, we observe where it is that because persons are at home, right, and it is that the government was giving individuals stimulus, etc., there was a shift in terms of persons buying certain services and they purchased more goods. So we saw like an 18% rise in terms of demand for certain goods, right, relative to where it is that it would have been trend on a normal circumstances. So as a consequence of that, we see a significant rise in inflation in the United States. In fact, the U.S. is used to inflation over the last couple of years of around less than 2%. For the month of December, the 12-month inflation went as high as 7%. So, that is indicative of the sort of, demand pull inflation, which is occurring in that side of the world.
So simply driven by increased demand. More people want stuff, and so prices go up.
Indeed.
Simple demand and supply and demand.
Indeed.
So, Damien, we've been hearing a lot about the Bank of Jamaica raising interest rates, and it's been said, well, they have said it, that it's a response to increased inflation. So what does one have to do with the other? What do interest rates have to do with inflation?
When interest rates are low, then it makes it cheaper for people to borrow to spend. And it's two channels that people borrow to spend. They borrow to spend on investment, construction, and they borrow to spend on consumer durables. So you stimulate more spending and therefore more of the demand pull inflation that Thea was talking about when interest rates are low. whenever whenever interest rates are low. So if inflation starts to get too high, one of the ways that the central bank can dampen that rise in inflation is by raising the benchmark interest rate. They call it the policy rate. But all of the interest rates that the commercial banks and the other lenders charge to borrowers sort of stack on top of that. So when the central bank raises its benchmark policy rate, then other lenders have to raise their rates too. So borrowing becomes more expensive and people borrow less and therefore spend less. So it puts a damper, puts a constraint on demand, on spending, and therefore on rising prices.
Hypothetically, is this what we've actually seen been playing out, or is it too soon to say whether it has had an effect?
That's a really good question. Now, over economic history and over a broad range of countries, we see a lot of evidence that this is actually how it works. There are two things we need to watch out for in this particular context. One is that, as Thea was pointed out, what is driving inflation at the moment is not only too much spending, that is there as well, but rising costs because of bottlenecks in the global supply chain. The ports are clogged up, and so goods are not going around the world as efficiently as they otherwise have been. And so that is causing, those shortages are causing costs to rise, and shipping costs have risen as a result. So the question is that when you're dampening demand, it is not as effective as a situation where the entire cause of inflation is too much demand. It's less effective if the cause is rising costs. But it's going to be effective nonetheless, just not quite as quickly and not quite to as great a degree. Second consideration is that the economy now is in an unusual situation because of the pandemic. So all the usual lags that we know about, the timing, how long things take to be effective, are different now, and we don't know how different. So even though the central bank is using the standard tool, and at some point it is going to be effective, we don't quite know how long it's going to take and to what degree.
So, Theo, are we actually seeing increased demand? I know in the United States, yes, because there's been all this printing of money and the stimulus. We haven't had that to the same extent here in Jamaica.
To the extent that you have to put it in context. If you may recall, 2020, there was a significant decline in terms of economic activities.
Right.
10.2%. Tourism, went down as much as 60%. So it is that you're coming from a low base. In fact, looking at 2021, the economy is expected to grow by 5.2%. So what that is indicative of is, an increase in terms of goods and services being purchased across the economies because of the low base and the general improvement in terms of, overall economic activities. So in fact, you have seen a pickup with respect to demand. But as the economy is still operating with low pre-COVID level, and you're not expected to get there until about 2023. So from the perspective of looking at, if the economy was growing under normal circumstances, you're still below the level that it was expected before COVID. Good. So you're not seeing a great increase in demand as a result of, say, wages and salaries, etc. What is actually happening is that you're having recovery in the economy owing to, what has happened in 2020 because of COVID. Good. So it is that, looking at demand in general, we are not seeing anything to indicate any excessive demand, as in demand deviating from the normal course, which was expected, prior to COVID.
Interesting conversation so far. So, Damien, I see you're wearing a nice pair of glasses. I hope they also give you foresight, because I want to ask you to look into the future a little bit, use your vision. Where does it look like inflation is going in the short to medium term?
That forecasting business is always tricky, and I don't want to get in too much trouble by pretending to be able to see into the future. Where is it going? Well, we said that the main problem globally are these bottlenecks and choke points in the global supply chain. Those eventually are going to go away. They're going to go away for two reasons. One is that at some point the traffic jam clears, but also because it is causing such a rise now in shipping costs and in the costs of getting through the ports, that that's a huge incentive for companies to try to increase the pipeline and to find ways around the problem. So it's going to go away. We don't know on what time frame. So what we are saying is that we can say with full confidence that that supply chain problem, as it is called, is going to go away, and we're going to go back to more or less the kind of global facility of shipping at some point. But we can't say what time frame is going to happen in, and that's a difficulty we have. So the inflationary pressures are going to dampen on their own, but the time frame is unknown.
Well, I have seen the BOJ saying that they expect it to go even higher before it comes lower, no?
That's quite possible, but the latest information that they have published does not necessarily indicate that it has to go higher. So we're not quite sure. And bear in mind that they have also, as we discussed earlier, they have increased their policy rate to try to dampen that increase. So to the extent that they are successful, then it may not go higher before it comes down.
So let's come to our own individual pockets now. Theo, since we are here in this high inflation environment, interest rates are going up. What should I do, or what can I do about it? Should I hold on to cash? What should I be doing?
Certainly, you don't want to be holding on to cash in a high inflation environment because it's eating away at your purchasing power. So it is that you really want to be investing and investing wisely, right? So you do not want to have cash at this point in time, or to limit the amount of cash you have. Certainly at this point in time.
So you said you want to be investing, and investing is a great way to hedge against inflation. You want to beat that. Where are we now? 8% locally?
Yes.
About 8% inflation, right? The Bank of Jamaica's target is to have inflation between 4 and 6%. So we're well above the target range. So if inflation is 8%, that means that if I'm holding on to savings, then I am losing money each year. So if I have $100, next year that $100 is only worth $92 because inflation is at 8%. So I want to be investing, as Theo advised, to beat inflation. But how do I do that in this environment, Theo? We heard last year that the Jamaica Stock Exchange only gained 2%. So the JSE overall did not beat inflation. So where do we look?
You had an extensive conversation earlier today with a group of guys, speaking about stock market, etc., as well as bond. Good. In terms of looking at the universe of assets, which it is that individuals are invested in, you look at stock bonds as well as you look at commodities, and potentially you would look at the real estate market. Now, for Jamaica, the options are relative. There are three broad options really in Jamaica: stock, bonds, and the real estate. For individuals who are not wealthy and those who are reliant on investment managers, you want to have an investment manager with a good track record. And naturally, it is that they're going to diversify their portfolio and look for different suite of assets which can generate the sort of returns to outstrip inflation. Good. And I suppose it is that by doing so, they will do it with a mix of different assets, includes bonds, stocks, and a mixture of real estate. Right? So it is that you really want to get invested in a with an individual, with an entity which has a good track record in terms of potential return on the investment assets which they are providing.
Here is something for you to think about in this not yet post-COVID economy. As Theo pointed out earlier, we are still below the level of GDP, the level of total output that we would have been at if there had been no pandemic. In fact, based on the last quarterly data that came out of Statin, we are probably about 6 to 7% below the level of output that existed just before the pandemic hit. So over the next 12 to 24 months, it is likely that the economy is going to grow by round about that. In addition to that, sort of on top of that, a couple of other considerations suggest growth. A second one, in addition to just recovery from the pandemic, is that recessions tend to be good for rapid growth, because one of the things that constrains economic growth is that when you get a new business idea and you want to start up a new activity, you need to bid working capital and bid labor and bid factory and office space away from their existing uses. The great, in quotes, thing about recessions is that it throws resources idle. So it's sort of easy for you to get into a new business and to build it up.
Especially if you don't have a job because of the recession.
Exactly. The other consideration is that more businesses have started up during this pandemic than in any other single year since they have started taking records for number of business started, both in Jamaica and in the US and in the UK and pretty much everywhere. People thrown out of work, start businesses, they try out new things. So recovery, idle resources available to facilitate growth, and innovation. All of those growth impetuses are now going to come into play over the next 20 to 24 to 36 months. That means that because there is going to be a fair amount of economic growth coming, you want to invest. You don't want to be holding on to cash. You want to try and get a piece of that somehow. So that is really the compulsion to make sure whatever savings you can get your hands on, you put it in some investment vehicle so you can enjoy part of that expansion.
It's an excellent point, Damien. I saw where the company's office reported that over 17,000 new businesses registered in 2021. I don't remember the number for 2020, but it was a very impressive number that year as well. In 2020, as a matter of fact, it was a record-breaking number, and then 2021 broke 2020's record. So I have a follow-up for Theo, but first let's go to our audience. I see a question on the screen, and somebody wants to know, what about holding cash in foreign currency? Theo, what do you think of that?
That is a very good question. And, that is part of the whole issue with respect to diversifying a portfolio. Good. With respect to you, if it is that you want to generate a high level of return on your investment, then it's a good thing to not just only have J-dollar investment, but also investment in US dollars or potentially other currency. And it simply has to do with diversifying and trying as best as possible to generate additional return. The truth is that we're in an environment where it is that the local currency is highly likely to depreciate. So if it is that you look at the average depreciation rate over a 10-year period, it is over 5%. So assuming it is that you're generating return of 3% on US dollar investment, in J dollar terms, that will be 3% plus 5% in terms of depreciation. So we're pretty much on par in terms of with the current inflation rate. So diversification does entail additional, or rather investment in other currencies outside local currency as well. So it is part of the mix with respect to the investment portfolio.
All right. Sure.
One additional element to that, though, that's an excellent point, and you always want to diversify your portfolio, especially if you're not investment savvy. So you don't want any one bad thing to happen to you and you lose most of your savings. But in looking forward at the depreciation of the currency we are likely to have, you have to bear in mind, you don't want to compare it by looking too far back, because a lot of the exchange rate depreciation that we have had in the past is inflation driven. And now that we have an inflation targeting framework in place, and they're aiming at the 4 to 6% range, then you're likely to see less depreciation going forward than you've seen in the distant past. So you just need to bear that in mind as well.
So here's the thing. A lot of people tend to put money into US dollars because of the fear of depreciation, right? And we saw that happen during COVID. Pre-COVID, the Jamaican dollar was about 125, a little bit less to one US. And now we're at 155. So that is a quite significant difference. So things have gotten more expensive in terms of JMD to USD. But at the same time, haven't we also heard the BOJ caution against doing things like saving in USD because they say that this also drives up the cost of US dollars because now there's increased demand. Everybody's trying to buy US dollars to hoard it because it's a hedge against inflation for them or a hedge against depreciation. And that just ends up being counterproductive. What do you have to say to that, Theo?
From the perspective of the national good, I will not, you don't want to have a lot of individuals investing in US dollars because it is that you're speaking about increased demand for US currency and it's going to lead to accelerated depreciation in the local currency. And we've seen that in the past. Good. However, it is that, from the perspective of, as I indicate, a diversified portfolio, you want to hold different currency, right? Because it is part of the mix. So notwithstanding what the Bank of Jamaica is saying, to the extent that, you're in an environment where the currency is highly likely to depreciate. So you want to be in a position where it is that, you're actually generating a return from a J dollar perspective if the currency depreciate. I am not advocating for persons to go out there and wholesale buy the US currency, speculate on the Jamaican currency, but from the perspective of a diversified portfolio, right, in terms of holding US dollars, stocks, bonds, etc., you want to be in the mix in terms of protecting your investment, right, in the event of accelerated depreciation of the currency. So it is part of what it is that we advocate with regards to a diversified portfolio.
I think another thing that we should also consider is not just saving in US dollars, but finding ways to earn US dollars. So for me, I'm a YouTuber. I earn some US dollars via YouTube, via sales online to people outside Jamaica. And we can look more at exports. And exports are not only commodities and goods that can be sold, but things that you can do online. How can you sell your services to people outside of Jamaica and earn US dollars?
Theo has been talking about looking at the different classes of assets. And in that context, one can, in a way, look at foreign currency as a class of asset.
Right.
And if you compare, if for each of the last 6 or 7 years, you compare the growth in value of a range of investments in the stock market and compare it to depreciation, the stock market has beat depreciation in more years.
Oh,
Yeah.
it has.
Yes. By a distance.
Not during the COVID years, though.
Well, those are the years that brought it down. But every year before that, the stock market beat the depreciation.
Interesting. I'd love to see a chart showing that. So we've been talking about interest rates quite a bit this evening, but I want to take a little step back and just get into what interest rates are and how they work. So, Damien, let me have you take that one.
Interest rates are a price. It's the price of credit. Just like how you go to the supermarket, you go to the shop, and you have a price that you buy a bag of flour for. The interest rate is the price of lending and borrowing. And so it's going to be affected by supply and demand, by how many people are willing to save and make their savings available to be loaned to others, and how many people are coming into these institutions, the banks, to borrow. And once we see the interest rate as a price, then you don't want to look at a rise in interest rates as necessarily a bad thing.
So, Thea, how do I prepare for higher interest rates since they are coming based on what the BOJ has been setting the tone for? Should I just try borrow now before it goes up? How do I prepare?
Certainly, that is a good question. In the investment community, there are actually entities that have borrowed in advance. They have investment on the horizon, and it is that they know they desire to borrow. So it is that they have actually done just that. But from an individual perspective, what it is that you're going to borrow to do? Good, because it is that if you just go there and you borrow, and it is that you're not generating a return, but as Damien indicated, you have that cost in terms of interest. Good, then it is that it becomes a drain in terms of your disposable income, right? So what it is that you should be looking at is how it is that you can generate additional return. Good, given that you're going to have an increase in interest rates, right? So that is what you ought to be looking at this point in time, and given the discussion that the other guys had earlier, there's, it leans towards having looking at a good portfolio manager, good, who has a very good track record in terms of beating inflation, generating a high level of return, which is in keeping with what it is that you desire, good. So from this moment on, you should be looking at how it is that I can generate greater level of return given what is likely to come.
You remember earlier, Khalida, you said that if the exchange rate goes up, one of the things that you want to think about doing is earning foreign exchange.
Right.
Now think about that. When a price goes up, first thing that occurred to you is to become part of the supply side of that activity. So you become a seller of foreign exchange. The same thing applies to the rate of interest. If interest rates go up, then you should become a supplier of credit. You should cut back on your spending, try to save more, so you can earn this higher rate of interest.
How do you become a supplier of credit?
By cutting back on your consumption and saving more, and then taking your savings into a financial institution and invest in bonds.
So look at the
Because the interest rates are going to go up.
All right.
This is, I'm not saying bonds versus equities,
Yes.
A balance.
No, I'm not making a case for bonds versus equities. I am saying become somebody who is an investor in that sense, who is taking your savings and putting it either into equities or into bonds. But a rise in interest rates should incentivize you to become a supplier in the same way a rise in the exchange rate incentivizes you to become an earner, and a rise in the price of carrots incentivizes you to grow carrots.
Right, because a bond basically is you lending your money to a government or a corporation. So you earn interest, and it's the same, it's a loan. So you become a lender when you buy into a bond. What was my next question? I had something else that I wanted to ask Theo, following up on that very conversation. And it had to do with, yes, now I remember. So how do rising interest rates affect the government's accounts, Theo?
That's a very good question. Good. Recall it is that the government, you have the debt. The debt is currently around 104% of GDP, looking at over 2 trillion Jamaican dollars, right? So it is that debt come at a price in terms of it is that it is past borrowing, and when you look at the domestic component, I think it is that domestic component accounts for 34% of the overall debt. 40% of the overall debt, and within the domestic component, 34% of it is adjustable rate debt. Good. So you look at T-bill yields going up nearly 300 basis points, 300%, right? What that indicates is that, or rather 3%, sorry, you're going to be a rise in terms of the cost on the GOJ's account in terms of the existing debt. Good. You still have a situation, if it is that the government is likely to run a fiscal deficit, which is possible, given that you don't know in terms of how revenue is likely to turn out next year, given the course of the economy. If it is that they do generate a deficit, then they're talking about additional borrowing to the existing borrowing, and that they'll have to borrow at higher interest rate. Notwithstanding that, the government, there are maturities in terms of debt now. right? And it is that they're borrowing to the tune of around 70-80% of the existing maturity. And a lot of the debt strategy of the government is really to reborrow maturing domestic debt. So when it is that the government retaps the local market, they will have to do so at higher interest rate because is that investors are only prepared to lend to the government at rates which is reflective of the market interest rate. So it is that you're gonna see an increase in terms of the cost of government borrowing, and that line item on the fiscal account, which represents interest, is likely to increase over the next fiscal cycle.
And you mentioned when the government taps the local market. That's a very important point to note that a lot of the government's borrowing is from local people and institutions. It's from Jamaicans. Yes?
including the US dollar debt.
Right.
A large part of it is held by locals.
Right. So when that interest rate, so this begs the question then, Damien, can higher interest rates be a good thing?
Well, there are many circumstances in which high interest rates are a good thing. Doesn't mean they're a good thing for everybody. So again, let's go back to the carrot. Let's go back to the price of carrots. When the price of carrots goes up, is that a good thing or a bad thing? Well, if you're somebody who is a consumer of carrots, then it makes you worse off. If you're a farmer and you sell carrots, that makes you better off. And the same thing applies to interest rates. If you're a net borrower like the government, then higher interest rates are going to squeeze your budget. But if you are somebody who's a net saver, then higher interest rates are good for you. So it's hard to say it's overall bad for the economy. It's better for the savers and it's bad for the borrowers.
If I have an existing loan, Theo, what should I do?
It depends on the loan that you have. If it's an adjustable rate loan, then it is that you face headwinds in terms of the cost of borrowing to you is going to go up. If, however, it is that that loan is a fixed rate loan, then you would not have any issue because it is that it is fixed until it is that the loan has actually matured.
Right. So let's look at buying a property because that's a big thing for a lot of people, especially when it comes to buying a home. Damien, it's a big commitment, but do you see the increase in interest rates making it more difficult to buy properties?
Certainly it's going to make it more expensive because buying a home, taking out a mortgage, is the largest indebtedness that most people are going to incur in their entire lives. So it is going to squeeze the ability of people to take out new mortgages and therefore to afford new homes.
So will that affect the real estate market?
It's going to affect the real estate market. It's going to affect construction. The question that we want to answer to know how significant that's going to be is how long is that going to last? You know, the world has gone along, not just Jamaica, the world has gone along with some really low rates of interest for a few years now. Due to the pandemic, but not only due to the pandemic, due to basically an excess, a surplus of savings around the world. That was never going to continue forever. So I think it is fair to say that going forward, we're going to have, even after rates go up and maybe moderate after a while, we're going to have higher interest rates going forward in Jamaica and globally than we have had for the last several years.
How does this affect disposable income, Theo?
Well, I'll have to start from the perspective of inflation. Good. To the extent interest rate doesn't just rise because government wants to increase interest rate. It comes as a result within the environment that we are now. It's a result of higher inflation, and inflation is actually what in part drives wages, wage increase. So to the extent that we're likely to see perhaps at the end of the fiscal year 7-8% inflation. At the end of the December, inflation was 8.5%. Persons who are at the bargaining table good, with respect to their different corporate entities, are going to demand higher wages and salaries for their workers. So it's, you already have inflation, which occurred, and then it is that there's the expectation with regards to inflation. So individuals are going to negotiate their salary based on what inflation was, good, and there are other groups, for example, the government groups, who are going to demand higher salary based on what inflation is likely to be, going forward. So inflation does impact the cost of labor from the perspective in terms of the persons who are working and individuals who are bargaining on behalf of those workers, demanding higher wages for them.
But is the output there to support the higher wages, Damien? So everybody will be and are demanding higher wages, but are the businesses and the government producing enough to actually pay those higher wages?
You see, this is the reason why inflation is so important. This is the entire reason why it is so important that we've made the central bank independent, that we have asked the central bank to focus on a targeted rate of inflation. Because high inflation is one of the most pernicious things, one of the most difficult and intractable and damaging things that an economy can have. And one of the reasons why it is so damaging is what Theo just alluded to. That when we have low inflation, that gives you predictable inflation. Everybody knows that prices and wages are going to move at a low, predictable level over a long period of time. That's why the Bank of Jamaica took on that slogan.
Right.
Low, stable, and predictable. Once now we have this unexpected 8%, then workers are going to say, well, it looks like I'm losing, I need to negotiate, and the company is going to say, well, times are hard, and they're going to strike, and you'll have more industrial action and more unrest, all because we've allowed inflation. Well, I haven't allowed it. But if you allow inflation to get away, then you get back into that cycle of price increases, wage increases trying to catch up, contention. So that's one reason why focusing so much on this 4 to 6% range is of critical importance. And while people are concerned that Bank of Jamaica is raising their benchmark rates and making borrowing more expensive, it is because of the ultimate goal and the importance of having low, stable, and predictable inflation. So if it causes a problem in the short term, it's a price worth paying to get back to low, stable, and predictable inflation. And we could actually use the entire rest of the time talking about all the other reasons why high inflation is a problem, not just because of the wage price issue.
So the BOJ's response to high inflation, as we've been discussing, has been to raise interest rates. Theo, is this unique to Jamaica, or is this what we've been seeing as a response globally?
It's not unique to Jamaica. In fact, if you look across South America, right, so it is that Brazil raised the rate last year by 725 basis points, at 7.25%. Mexico did the same, Peru, Paraguay, because it is that they have been beset with high inflation and they do maintain inflation policy, right? You look at one of the countries which I tend to do a lot of work on, Dominican Republic, they maintain an inflation band within 3 to 5%. At the start of COVID, in order to provide stimulus to the economy, the central bank reduced the policy rate by 150 basis points. In December, they actually raised the policy rate back to where it was pre-COVID. So you're seeing where it is that a number of central banks across the globe, with the exception of the Chinese central bank, have begun the process of increasing rates because of the implication of inflation on their economy. Looking ahead in terms of the Federal Reserve, the expectation is that they will increase their rates at least 3 times next year, because we see at end December inflation was 7% and the Fed has a target of 2%. So you're likely to see increasing global rates, right? And it is not something which is unique to just Jamaica.
Do we have any questions from the chat? All right, so while they bring those up, all right, I don't think we have any yet, and don't all rush at once. So if you have any questions, now is the time to type them in the chat because we are coming towards the latter part of our conversation with our esteemed panel here. Now, I remember during this entire conversation, early on in the conversation, when the BOJ first announced that they would be raising interest rates, I had an opportunity to speak with the BOJ Governor Richard Biles and put some of these concerns to him. Say, well, there's been this concern that if you raise interest rates, it is going to be more expensive to borrow, and that's going to be a constraint to businesses, and it's going to be counterproductive. And I recall distinctly that his response to that question was that it's more important for the BOJ to protect the consumer, to protect the average individual, than it is to protect businesses, who employ the average individual, by the way. I'd like to hear what your thoughts on that are.
Yeah, let me go beyond that answer. It is more important. It is true that raising interest rates now, the economy is struggling to emerge from the recession of the pandemic, and raising interest rates is going to dampen, it's going to constrain that recovery. And we are all eager for the economy to recover. But low inflation is critical to an economy's ability to sustain long-run growth. That low inflation means low and predictable depreciation as well, low and predictable wage increases, low and predictable cost increases, and that facilitates long-term planning and long-term investment. So low inflation is important to long-run growth. What the Bank of Jamaica has said is that sustained long-run growth is more important than recovery over the next 12 months. And on that, they're absolutely right. That what we want is an economy that's going to be growing 3, 4, 5, 6% over the long run. If it takes us longer to recover, then that's a price that is worth paying.
But then how do we achieve sustained long-run growth? Is it not through businesses borrowing
Through
cheaply
low,
and growing?
stable, and predictable inflation. That is what creates a stable investment climate that people can do long-term planning with. And the only uncertainty that you have to think about when you're planning an investment with a 20-year payoff is, am I putting it in the right market? Am I designing my products the right way? In other words, uncertainty in relation to your business and your market. You don't have uncertainty in relation to things outside of that in the rest of the economy.
You want to add there, Theo?
Well, it is that my view, as well as that of my colleagues, was that the BOJ may have increased rate a bit too soon, given that where the source of the inflation is coming from, right? And to the extent that the economy is in a recovery phase, then from that perspective, we are of the view that the bank should have waited a bit, because it is that it would have significant implication in terms of the recovery mode. Now, Dr. King spoke about the long-term growth mode and so on, and that is indeed correct. But the short-term implication can be very significant and does affect the long-term growth trajectory. So it is that while it is that I do agree that at some point in time rate adjustment will have to take place, I don't necessarily think that doing so at this particular point in time was needed, given the source of the inflation impulse.
I see a question coming in online, so let's take this one. Earlier, there was the mention of diversifying to hedge against inflation. Is there a risk with over-diversifying? Is there even such a thing? Theo?
All right. Grandma always said, "Do not put your eggs in one basket." Good. Certainly, it is that from a return perspective, you could have a situation where over diversified portfolio doesn't necessarily generate as higher return as if it is that it wasn't greatly diversified. But nonetheless, it's a means of protecting yourself. And when it is that we look at portfolio, we encourage no more than 5% in any one asset, right? At least from our perspective. But then if it is that you do desire to earn a little more, right, you'd have to take additional risk, and you may have to go outside of that 5% in terms of, the asset class or the particular asset, right? So it is that it's a matter of the risk tolerance of the individual, as well as the age of which includes the age of the individual and what it is that the individual desire to achieve Okay, so it is from that perspective. You don't just invest in assets simply because it is of the return only. You look at the profile in terms of the time frame that you want to recover the investment, as well as the sort of return that you wish to generate. So it is that you may have to diversify within the 5% range, or you may have to tilt the asset in order to achieve a greater level of return.
Right. It's generally accepted that younger people can take more risk because you have more time. I'm including myself in this. We have more time to recover if things go bad. Don't laugh, David. You can't take no risk.
No, I can't take any risk. And I need to be fully diversified.
So here's another question coming from our viewers. Is there anything that the government can do to reduce the effects of cost-driven inflation? Damien.
No, we've been discussing here about the challenge of using a demand-depressing tool to address what is essentially a supply-side cost-driven problem. And what is not a perfect fit, that is the only instrument the government has. And it is going to have an impact because, as we were saying earlier, higher interest rates not only reduce borrowing to spend, it incentivizes savings as well. It incentivizes the individuals to spend less so that they can save and take advantage of higher rates of interest. So it is going to have an effect, but not quite as rapidly and not quite to the degree as if the inflation was entirely because of too much spending. But that's the only instrument they have.
All right. Well, as we come to the close of this session, let me just ask you both, what are your final takeaways for our viewers? What would you like to leave them with, Theo?
Interest rates are on a path of upward. They're moving up. From an investment perspective, as Dr. King indicates, it's a time where it is that you have to assess your spending and now start looking at investing, right? With a mean of generating additional return for yourself with a view perhaps of consuming more in the future. So it is that you as, we want you to look at investment managers who can generate that level of return for you which you desire. So it is that, the takeaway is to reduce your spending if it is that you can and start thinking about investing and investing in a way where it is that your portfolio is relatively diversified and you're generating returns which outstrip inflation.
And Damien?
Well, there are two considerations I would like to leave viewers with. One, which is just generally good advice in terms of your personal money management, is to save and invest. That, you save a small share of your salary each month or a share of your income, and you put that into something and you do that consistently, the miracle of compounding is going to make it get somewhere. But particularly at this time, because COVID notwithstanding, many challenges to the economy notwithstanding, Jamaica is in a pretty good place on a global comparison in terms of the possibility of significant economic growth. And if you happen to be here, it's a good place to be putting your investments. So that's what I would like to leave people with.
Well, thank you very much to Damien and Theodore. This has been a very enlightening conversation, and I hope that you have learned a lot more about the high inflationary environment and how this is, and may affect your pocket. So I'm going to take it over to Carrie Ann, who is standing by.
Thank you. Let me tell you, I was sitting off to the side here, just kind of taking everything all in because I see this as a learning opportunity for myself. And of course, as part of the planning team, when you hear a rich discussion being moderated by an awesome moderator, and then you have the panelists who round it out with their knowledge and expertise, you really feel a sense of deep satisfaction and gratitude for what was really a great session. And I thank you so very much, everybody, everybody. Kalila, Damien, Dr. King, I feel we were calling him Damien. Although we used to call you Damien behind your back. But he was
Damien.
Dr. King and Theodore. Thank you so much. I mean, so many rich nuggets. I mean, I see the comments in the chat with our audience concurring, really rich nuggets. And again, we are a very necessary conversation as we thought, because at the end of the day, the economy that we live in and work in and operate in is a crucial part of the decisions that we have to make. And so we are appreciative of the fact that we were able to have this particular discussion. Thank you very much. And yeah, awesome. Wishing you all the best for 2022. All right. So let's do some quick housekeeping to wrap up tonight's event. So thank you very much. We just concluded session 2 of day 2, the final session for day 2. We're going to be moving into day 3 tomorrow. I'm so sorry. Somebody's going to have to tell me what time we're starting back again tomorrow, because I don't remember right now. All right. 4:30. All right. Yes, there we go. You see, when you have so many useless facts you're trying to remember with no paper in your hand and no glasses on your face. So 4:30, we're going to be starting back tomorrow, Sunday, when we're going to be starting back. We're going to have 2 sessions tomorrow as well. So get your notebook ready. You can't eat your Sunday dinner while you listen. Don't worry about that. We don't care. We won't see you. Just tell everybody that you know and love to come and join you and take in the good information. Tomorrow, we're going to be talking about investing in real estate, and we're going to be talking about cryptocurrency and investing in international stocks, primarily New York Stock Exchange. So I know you don't want to miss those sessions, all right? So come back and join us. Of course, thank you to everybody who would have been participating in our social media activities to take part in the giveaways. Please keep the tweeting going. We're going to be looking at those tweets right up until 10 o'clock tonight. Remember that at 9:15, which is not too long from now, we're going to be having a Twitter Spaces session, about 30 minutes or so, with David Rose and our very own Clive, talking about continuing the stock market investing conversation. Blah, blah, blah. So please join us on Twitter for that session. And of course, we want to thank our sponsors. We can't end the day without thanking the sponsors, without whom Elevate would not be possible. Express Fitness, Domino's Pizza, Water, Cran Water, Living Simple, and Brescia. Thank you very much. And of course, look out for the survey that's going to be coming your way tomorrow on day 3. We're going to be having our post-event survey. We invite you to give your feedback. Tell us what's working for you, what didn't work. And of course, there's a chance to win a prize if you complete that survey as well. So please share your feedback with us. And on behalf of the entire JMMB team who has been, and our supporting cast here in the back. I wish I had a camera to just kind of zoom back to see what's going on in this room. But thank you so much. We thank you for joining us, taking the time to join us, and we look forward to seeing you back here tomorrow afternoon, 4:30. Thank you. Cheers.
Young, go tell the beat.